Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Leveraged Buyouts: how they work, benefits, risks, and real-world examples. Buying a company using borrowed money might sound risky, but it's a common strategy in the business world. Known as a leveraged buyout, LBO, this approach is used by private equity firms to acquire companies by using debt to finance the majority of the purchase. It's a powerful tool that can lead to big results, but it's not without its challenges. In this video, we'll break down how LBOs work, why they matter, and the risks and rewards involved, along with real-world examples to bring it all to life. What is a leveraged buyout? A leveraged buyout, or LBO, is when one company buys another using a mix of its own money and borrowed funds. The debt financing often makes up the majority of the purchase price, and the acquired company's assets typically serve as collateral for the loans. This method allows firms, particularly private equity companies, to acquire businesses with less upfront capital. While it can be a lucrative strategy, it also carries significant risks if the acquisition doesn't perform as expected. Origins of leveraged buyouts. The concept of leveraged buyouts dates back to the mid-20th century. The first wave of LBOs appeared in the 1950s and 1960s, driven largely by investment firms looking to acquire undervalued companies. As credit became more accessible, these types of transactions grew in popularity, especially during the economic boom of the 1980s. The 1980s were a defining decade for LBOs. High-profile deals, such as the $25 billion buyout of RJR Nabisco by Kohlberg Kravis Roberts & Co. KKR, brought LBOs into the mainstream. This era also saw the rise of junk bonds, which provided a critical source of financing for these high-debt acquisitions. In the decades since, LBOs have evolved. More sophisticated financial modeling and stricter regulations have helped reduce some risks, but the core principle remains the same: using debt as a tool to acquire and grow companies. Today, LBOs are a central strategy for many private equity firms around the world. Key components of an LBO. To understand how leveraged buyouts work, it's important to know the mechanics behind them. Several critical elements are involved in a typical LBO transaction. Equity contribution. The buyer invests a portion of their own capital. While this is usually less than 50% of the total purchase price, it's essential in securing the necessary loans. Debt financing. The bulk of the funding comes from loans or bonds, often split between senior and subordinated debt. Senior debt is considered less risky and has priority repayment, while subordinated debt carries higher risks and yields. Collateral. The assets of the acquired company often act as collateral for the loans. This means the company's properties, inventory, or even cash flow back the borrowed funds. Cash flow projections. Lenders and buyers rely heavily on the acquired company's ability to generate consistent cash flow. This cash is used to service the debt and eventually pay it off. Operational efficiency. Post-acquisition, the buyer often looks for ways to improve the company's performance. This could involve cost-cutting, restructuring, or scaling operations to increase profitability. Exit strategy. The buyer's goal in an LBO is to eventually sell the company for a profit. Exit routes include public offerings, selling to another firm, or merging with other businesses. These components work together to make LBOs a high-reward, high-risk strategy. The success of an LBO hinges on careful planning, strong financial projections, and, often, a bit of luck. How leveraged buyouts work. Leveraged buyouts, LBOs, aren't just financial maneuvers, they're strategic plays built on careful assessment, planning, and execution. Private equity firms orchestrate these transactions to acquire companies, relying heavily on borrowed money. But how does the process work in practice? Let's break it down step by step. Identifying targets for LBOs. The first step in any LBO is identifying the right company to acquire. Not every business is a suitable candidate, so private equity firms focus on specific criteria: stable and predictable cash flows. Companies with steady cash flows are ideal since future earnings will be used to pay off the debt. Think of businesses in industries like consumer goods, healthcare, or utilities, where income tends to be more consistent. Low debt levels. Firms with minimal existing debt make better targets, as they can handle the added burden of new loans without becoming overwhelmed. Strong asset base. Companies with substantial physical or financial assets are attractive because these assets can serve as collateral for loans. Operational efficiency opportunities. A business with room for improvement, whether it's reducing costs or increasing revenue, offers potential for higher returns. Experienced management team. Firms with skilled leadership teams can simplify the transition process for private equity buyers and boost the company's post-acquisition growth. Essentially, private equity firms hunt for diamonds in the rough, businesses that show strong fundamentals but also have untapped potential. Financing the buyout. The backbone of any LBO is its financing. Private equity firms use a mix of debt and equity to fund the acquisition, with debt making up the larger share. Here's how it's typically structured. Debt financing. This is the largest chunk of the funding, usually 60–80% of the purchase price. Debt can come in several forms: senior debt, secured loans from banks or financial institutions. These loans have lower interest rates but must be repaid first. Subordinated debt. Higher risk loans with higher interest rates, repaid after senior debt. Mezzanine financing. A hybrid of debt and equity, often providing lenders with an option to convert debt into ownership if repayment fails. Equity contribution. The private equity firm invests its own capital, often 20–40% of the purchase price, to secure loans and demonstrate commitment to the deal. Using debt allows firms to maximize returns. By committing less of their own money, they increase the potential profits when the acquired company is eventually sold. However, this leverage also amplifies risks, requiring careful management to ensure the company can handle the debt load. The role of private equity firms. Private equity firms are central to leveraged buyouts, not just as financiers but as strategists. Their involvement goes beyond the acquisition itself. They are hands-on in guiding the company's transformation. Here's how they add value. Operational improvements. Post-acquisition, the firm often implements cost-cutting measures, optimizes supply chains, or invests in areas like marketing or technology to improve efficiency. Strategic growth. Private equity firms focus on scaling the company, whether by expanding into new markets, launching new products, or acquiring complementary businesses. Debt management. They carefully monitor the company's cash flow to ensure debt payments are met without disrupting operations. Exit planning. From day one, private equity firms strategize on how to sell the company, aiming to achieve a lucrative return. This could mean a public offering, selling to another firm, or merging with another entity. In essence, private equity firms operate like coaches, steering the company toward higher performance and, ultimately, a profitable exit. By combining careful target selection, creative financing, and strategic expertise, LBOs can unlock substantial value for investors. But as with any high-stakes venture, there's no room for error. Success hinges on meticulous planning and execution at every step. Benefits of leveraged buyouts. Leveraged buyouts, LBOs, are popular because they can deliver value for investors and the companies involved. By mixing debt with equity, LBOs create opportunities for profits, growth, and efficiency. Below are 3 key benefits of this strategy. Potential for high returns. One of the main reasons private equity firms pursue LBOs is the chance for significant returns. By using borrowed money to fund most of the purchase, these firms can amplify their profits when the acquired company performs well. Here's how it works. With a smaller upfront equity investment, the return on that initial investment increases dramatically as the company grows in value. For example, if the firm's equity contribution is only 30% and the sale price significantly exceeds the initial cost, the profits relative to the equity are much higher than in a traditional purchase. The extra risk of using debt comes with rewards when the strategy works. Those willing to manage the challenges can see results that often outperform other investment approaches. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.